All right. Good morning, everybody. Welcome to Mainnet. I think we're still at the point where everyone's kind of, filtering in. So death and taxes. Let's hit the taxes because I don't think we're going to solve death today. So I want to start and just kind of give everyone up here an opportunity to introduce themselves, kind of give you a feel for like what it is they and their company do, because we do have a couple of different firms represented. So we can just start right here, closest to me. Go ahead.
Oh, hi, Sam Leichman. I lead the crypto Web3 practice at Propeller Industries. We are a full-stack CFO down to staff accounting fractional solution for VC-backed startups. Have been around for about 15 years. I got my start at Propeller working in SaaS, and about 3.5 years ago during our sourcing meeting, our lead came in and said, we've got a new client that is doing Bitcoin, crypto, blockchain. We have no idea what they're doing, who wants them. And I raised my hand. That client was Solana Labs, they're still our client, but that was the start. We're working with about 40 great projects, and glad to be here.
Thanks.
Hey, this is Shehan, head of tax at CoinTracker. CoinTracker is a software tool that connects with your wallets and exchanges, automatically reconcile your numbers and give you the tax report so you can be tax compliant.
Hi everyone, Zlatkin. I'm the Chief Tax Officer for Coinbase. Hopefully Coinbase doesn't need an introduction. We're one of the largest crypto exchanges in the world. And as Chief Tax Officer, I have a responsibility for the broad array of issues involving crypto for Coinbase, the company, but also trying to build systems and protocols so our customers, our users, can pay their taxes appropriately, use our website for information, be able to track things. We're also global, so we worry about taxes outside the United States as well. It's a pleasure to be here.
Hi, I'm McClure. I'm the co-founder and CEO of TokenTax, which is crypto tax software for tracking your trades and everything you do on DeFi, filing with TurboTax or however, and also a full-service accounting firm for special situations in the space. More complicated than the software solutions that are out there. Thanks.
So we were all chatting before, we kind of made our way over here to the stage. And it sounds like the consensus, at least among the panel, is that, taxes is kind of the thing that projects have been punting on for a long time, but push has come to shove. And folks kind of really need to, get right with how they're going to handle taxes. So I guess for you guys, and anyone can kind of pick this up first and we'll run with it from there. If you're a project that hasn't already considered what you're going to do about taxes, how you're going to make sure your users can, get information to their accountant, what do you need to start doing now? What's the first thing you would tell a project to do now if they hadn't really considered what to do about taxes yet?
I think the rest of the panel can go much deeper on tax. I think my lens is really how do we get ready, and we deal with businesses, startups, but how do we even get to the point of actually delivering financials to our CPA partners? And really, I think the first thing that is, the first thing you learn in accounting is revenue is recognized when it is earned, and your taxes are due in U.S. dollars. I spoke with a project, a PFP project, that sold out, did $7 million in revenue in Q4, but they did not sell any of the ETH that they brought in, and they're very much underwater now. And I think in terms of, again, getting to the point of paying taxes, it is how do you take on-chain activity and turn it into basically, how do you take on-chain activity and translate that to QBO? And on the income statement, that's revenue, it's cost of sales and expenses. And when you have outflow in crypto, that could also be triggering cap gains, which will result in realized gains and losses. And then tracking all of that on the balance sheet, you need to be, digital assets are considered a intangible asset and has to be tracked at the lower of cost or impaired value, which brings up a whole issue of really the balance sheet for a crypto project startup is fundamentally broken because you've got no sense of your liquidity. This is probably more of a treasury discussion than anything else. But really, I think getting to the point of being able to take that on-chain activity and bring it to your financials is probably step one of getting ready to pay your taxes.
Great, thanks. Anyone else want to jump in on that? What do you need to do if you're a project and you haven't thought about this yet?
So I just want to remind people that taxes is unfortunately an unalterable part of your life. So so most people like to not think about taxes, and so I spend my lifetime doing that. I think one of the things that crypto, which makes it taxes in crypto really interesting, but also something that everyone here should think about is the first question really is, do you have a taxable event? So crypto is so new, some of the things that you guys actually do may or may not be taxable. And so we spend a lot of time developing products, advising our users as to whether they are taxable or not. We try and at least encourage them to think about it. So before you even think about the nuts and bolts about reporting, the first real question is, I'm staking. Is the income I'm earning from staking income? ETH just went through the big merge this past week. So is the merge taxable? How would it be taxable? So you have to sort of think about what you should be taxed on. Once you reach the conclusion that you are being taxed, the best thing that I would recommend that people do is keep adequate books and records and to not ignore the issue, because the Internal Revenue Service, all global authorities, their number one focus is enforcement. They don't give us as much advice on how crypto is taxed, but they are laser focused on ensuring that people actually do report their taxes appropriately. And so if you look, for example, at the 1040, which is our principal tax return, the front page, right below name and address, is a question about crypto. And it's changed each year. This year, it's focused on digital assets as opposed to virtual currency. They've updated that. But they also want to focus on, are you gifting crypto? What are you doing? Are you earning income through crypto? Are you disposing of crypto? And once you answer yes, and you should answer if you're actually doing those things, you should be thinking about, okay, that may or may not be still taxable, but what do I have to do to report it? How should I be accounting for it? How should I be thinking about it? It's just something you should keep top of mind.
Yeah, and then, well, real quick, Zach or Shehan, do either of you want to jump in on that? Kind of like, I guess if you're getting started figuring out what to do with taxes, what are some beginner tips?
Sure, yeah, I'll add quickly here. It's a cliche, but an ounce of prevention saves a pound of cure. And mentioned earlier, if you're launching an NFT project and you have 9 million in revenue or 8 million in revenue, maybe if you did that in Q1 of the next year instead of Q4, it would be a much better outcome because of our arbitrary calendar year situation, and just understanding, hey, before I get this money in, I'm going to owe half of it, or if you're a C Corp, 21%. Knowing how much you need to set aside in stable coins or in dollars to pay that bill is so much better than finding out 10 months later when you tell your accountant about it, oh, wow, I have a $3 million tax bill, but the crypto's only worth $2.5 million, and we need it to build the company. So what do we do? And the same goes for your personal taxes. 2021 taxes are due October 17th, so it's coming up. But you actually are supposed to pay those taxes quarterly throughout the year. So the people that did that and sort of tried to keep track in real time are in much better shape than the people who are figuring it out retroactively 10 months, 12 months, 18 months later in some cases, and not really sure what they did, and not realizing, wow, all these things are taxable events. Trading crypto to crypto is a taxable event. So.
Do you want to add anything there? Or?
Yeah, I think just to add to what Lawrence mentioned earlier, so that infamous crypto question, this is the 4th consecutive year that we're going to see this on the tax forms. So IRS is obviously trying to gather a lot of information about people who are non-compliant, because if you look at the number of people who are transacting in crypto in the US versus the number of returns that the IRS is getting with some type of crypto transactions, there's a huge discrepancy. So they're trying to find out the reasons, and getting answers to that question is one of the ways that they're doing it, in addition to the enforcement efforts that Lawrence is talking about. We kind of spoke about taxable events. I also want to make a point that it's also important for you to track your losses, especially during bear markets like what we're going to right now. These losses can help you offset your cryptocurrency related gains, even stock gains in some cases. And if you have excess losses, you can carry it forward into future years. So when you have gains in future, hopefully when we have the next bull market, you can use those losses to offset those gains. So it's important to track your taxable gains and pay your taxes, and also to track your losses because that's going to help you save taxes.
So I want to take a step back real quick because I want to be mindful that some people maybe don't have accounting backgrounds necessarily, as I know so many of you do. Let's do a quick explainer. Taxable event. What is and what isn't a taxable event? Or can you give some examples, like within the world of crypto, what is and isn't a taxable event?
So one thing that isn't a taxable event is the mere purchase and hodling of crypto. So if all you do is go to Coinbase and you buy Bitcoin, you hold it for 5 years, nothing happens. You don't even technically have to report that you have crypto on your tax return. That's not a taxable event. The ETH merge, we believe at least, is largely non-taxable. So if ETH went from proof of work to proof of stake, it's the same token, same coin. We don't believe that created a taxable event, but it could have. And so that's actually an open question. It's more at the margin than it is a definitive answer. The proof of work token that resulted, the fork itself, is a taxable event, at least according to the IRS. So you may form a different view about that, but that's taxable. Crypto to crypto is taxable. Crypto for fiat is taxable. Those are taxable events.
And maybe to, again, think about this from a corporate lens, actually, in the course of revenue, cost of sales, and expenses, if you're transacting in a non-stable coin digital asset, you actually can have multiple taxable events. Revenue is income. If you are using, let's say, ETH or any other digital asset as a cost of sale or as an expense, you do have a basis, and you could have a gain that you will be taxed on as well. So it shows up multiple places on the income statement.
The one thing that I think is somewhat surprising for people as well is that if you do what I call a micro transaction, so you have a Coinbase Visa card, for example, or you have another way to monetize your crypto, and you buy a cup of coffee at Starbucks, because you figure, well, it's just a cool thing to do. I'm going to use my Bitcoin to buy a cup of coffee. That actually technically is a taxable event. There's no exclusion for that. And as I've presented actually to the IRS and to people in Congress, I think we have a looming problem, because if you do that extensively, you will have potentially thousands of transactions. Just think of all the things you might actually do, thinking that crypto is like currency. I'm going to use it to monetize it in some way. And that could trigger gain or loss. And most people don't either know that or aren't tracking that.
And not to refute what you said, but if you go out and you buy an NFT with ETH and you acquired that ETH at $600, you will have actually a taxable event on the disposition of the ETH. So it's all over the place.
Right. The IRS treats crypto as property.
Right.
So it doesn't treat it as currency. It doesn't treat it as a fiat itself. So it's property for tax purposes. It's not security. It's not a commodity. It's basically just property. So anything you do with it, monetize it, triggers gain or loss.
And then we've kind of alluded to it here already, I guess, just kind of when you guys were doing some of your intros. How do you keep abreast of what the IRS wants people to be doing? Because as has been pointed out many times, not just here, there's not a lot of guidance. It's really just you find out what they don't want you to do because, they're coming down on somebody. They're going after somebody. It's punitive. So, what are your tips for other projects, other companies to kind of try to keep abreast of this kind of stuff?
Get a good tax accountant or a tax lawyer. Call Sam.
Obviously, we're biased, but yeah, talk to a good accountant, lawyer.
I think that, and I like that. I think we came to the same conclusion at exactly the same time. But getting a really high quality CPA at a tax firm is one of the first things that we do when a new client comes in is make sure that they have excellent crypto tax representation, and this ranges from Deloitte to regional firms to there are a couple of great boutiques out there. Happy to make referrals if anyone is actually freaking out that they don't have a good crypto tax help.
I think the basic aspect of tax is probably evident to most people. Just think of if you have property, you exchange it, you do something with it, that's going to be a potential taxable event. As I said, I think the harder point is, what about yield? What about you buy USDC and you get a revenue share from Coinbase or another exchange? Or I stake income and I receive a staking reward. Is that taxable? And there's really no guidance from the Internal Revenue Service on that. The whole issue about whether staking rewards are taxable is actually a source of controversy. There are people who believe that it shouldn't be, but the IRS takes a different view, or at least we believe the IRS takes a different view. So I think those are more the marginal questions. When you're in DeFi and you're engaging in transactions with DeFi, you're using ETH to buy an NFT. Those are things that people wouldn't otherwise think about. So when you question it, when you think you have just something that is challenging you don't know, consult with someone who might know. But don't assume the IRS actually knows either, because the reality is, I mean, we talk to the government a lot. I think they're very much trying to scope out. There are different parts of the IRS who think about this, but the Chief Counsel's Office in the IRS, which is entrusted with the authority and power to advise people, and is a really good team, they need to also learn what we're doing and then provide guidance on what we're doing.
Yeah, and I'd say, there isn't that much guidance, but there are two main things the IRS has actually said, and I'd say go straight to the source, read those. In 2014, they said, hey, it's property, not currency. And as, the panel here was alluding to, largely, I think because when you're trading currency to currency, like you're in Europe, you're spending euros for dollars, you have a tiny gain on a lot of the things you're buying. So they have a $200 de minimis exclusion on currency to currency transactions. And the IRS, I think, was trying to clarify, like, hey, there's no de minimis exclusion on crypto to anything. So it's property. But then that's like, people have run with that. And then the only other guidance they really gave that was substantial was October 2019. So do yourself a favor. Go read that. It's like 8 pages. Yeah, it's painful, but you'll know, hey, airdrops, forks, the IRS has said those are taxable. They're ordinary income. So at least you'll know what's actually fact versus just like speculation. And, I hate to say it, but you can't believe everything you see on crypto Twitter or even CNBC or, it's like people are trying their best, but this stuff is complicated and some things are borderline, inaccurate to say the least. Let's put it that way. And I think people in this space are often emailing journalists like, hey, did you really mean that? Or like, what's your source? So let's talk through it. But you have to be really careful out there, unfortunately.
Yeah, what I've heard, and this is anecdotally, is that if you're at least making some effort to pay your taxes, even if you've gotten it wrong and maybe misinterpreted what the guidance is or what the guidance is meant to be, at least you've made an effort. You're probably in better standing than just saying, I don't understand what I'm supposed to be doing, so I'm not going to do it.
Right, you shouldn't ignore it. And so I think the FAQs from the IRS are very helpful. They are from the IRS, you just have, and they do make an attempt, they update that FAQ pretty regularly. If you go to the Coinbase app, I'll just say that we actually have a number of modules and documents that you can actually read. You can actually track your gains or losses on Coinbase as well, if all you do is Coinbase. So we do offer a mechanism for people to understand what is taxable, how they should be thinking about it, what capital gains even means from a tax standpoint, like what constitutes income. So we try to facilitate and help people do that and remind them that they do have tax obligations. So.
And then I just want to say we're getting close to the 10-minute mark here. We've been told that we can take questions. So if you guys think you have questions, get a hand up, and I'm told that they can bring a mic around and we can. Okay, cool. I see some hands. So let's keep talking while we get the mic out now, but we'll get to the questions next. So I want to talk a little bit, specifically about the ETH merge. That's very recent. And as you guys have pointed out, it is kind of like an open question, was that a taxable event? And I guess it depends on what you were doing going into it. Were you just holding ETH? Were you staking? So I guess if you can kind of walk me through some of the considerations for this, what people need to know about this if they were holding ETH or had staked some ETH.
Yeah.
Yeah, go ahead.
Sure. Maybe I'll take a step here. So if the proof of work Ethereum didn't happen, the whole merge, in my opinion, was akin to a soft fork. So it's not a taxable event because the chain went through a deviation. You got all of your proof of work Ethereum got replaced with proof of stake Ethereum. So IRS has been somewhat clear in that type of scenario, and that doesn't trigger a taxable event. However, what happened was proof of work chain continued to exist. Again, I don't know how successful it is today. I think proof of work Ethereum is trading around like $10 a coin. But now we had to ask the question, was it a soft fork or was it a hard fork? If it was a hard fork, the new coin that you get triggers a taxable event. Again, it's up to debate. Would love to know the opinions of the panel.
Yeah, I mean, I think all you need to know about crypto tax in a nutshell is that, you know, Lawrence listed this as like the second least controversial, or, you know, it's just, but meanwhile, it's like, is it a soft or hard fork? But, you know, make a good faith effort to the best of your abilities. It seems like most people are saying, hey, switching your part of ETH that, you know, switch to proof of stake, not a taxable event. All the airdrops you got are a taxable event. So whatever the dollar value is, you owe like half of that in taxes. So don't end up upside down, because capital losses do not wipe out ordinary income, which this airdrop or fork or whatever you want to call it is. So luckily it wasn't, you know, a large economic airdrop, but yeah, it's complicated.
I think the best, my best take on it is we don't have to deal with this until next year's taxes. And
That is good.
I think also, we were talking about, I mean, the regulatory regime moves very slowly, but it will come, and I think, you know, having a little bit of kind of calm to wait and see what comes, and then have probably a very busy time to get tooled back up is kind of what I'm expecting next year or the following when this gets clarified.
Just a couple of comments about ETH itself. So I think, as I said before, we don't believe that the ETH proof of work to proof of stake constitutes a taxable event. So if that's principally what you hold and do, that don't worry as much about it, because nothing fundamentally has changed other than the fact that the validation system is different. If you are eligible to receive proof of work, the new version, ETH, whatever, ETHW, that is a taxable event. The IRS has said that a hard fork, whatever you may think about that, that is taxable. But you may not actually have access to that proof of work asset. And if you don't have what we in tax land call dominion and control, so for example, you hold on an exchange that won't give you access to the proof of work asset, you can't trade it, you can't monetize, you can't do anything with it, it's totally locked, then you don't have to worry about that as well, because you can't be taxed on what you don't have control over. So I think that's also pretty clear. ETH staking itself will constitute the staking rewards. At some point will constitute income, but it's also a question of when you actually have control over the staking rewards, because, you know, that's all relatively new. Some of exchanges have provided you with rewards and locked them up. And so, again, that's something you don't worry about until you actually have dominion and control, or constructive receipt. We have a lot of fancy terms we use for that. And it's largely based on, can I do something with it? Can I convert that into something else more what I'd like to say is, can you monetize it in some way?
Okay. And then, okay, so I know I saw 2 questions up front. There might be more, and a third. So I guess I saw these 2 hands first, and then I know we've got another one back there.
Hello. There's a lot of startups in the room, and many of us are paying consultants and advisors in future tokens. So any advice around the time it becomes taxable, or valuation method used pre-ICO, or before a tie-up period?
Yeah. Oh, sorry. There's a number of valuation firms that specialize in token valuation. It's kind of the equivalent of a 409A, but not exactly. But there's a variety of valuation methods that they'll run through. And yeah, getting that done, it's not nothing, but it's not a huge expense.
But yeah, again, an ounce of prevention saves a pound of care. I think it was Filecoin got fined hundreds of millions for. Make sure that you're putting that compensation on the W-2s of your employees. If you're paying 1099s or people overseas, make sure you have the W-8 Benny, that you have like, all right, we have a tax treaty with that country. They're paying taxes in their country. All those tokens are income to those people. when they vest or when they receive it, or if they file an 83B, which can often make a lot of sense within 30 days of being allocated that grant, that can yield big tax savings if the token is worth a lot less when they get the grant than when they actually vest it years down the road. Yeah.
And to that point too, unlike an option, you're taxed on the value of what the grant is. So it can get tricky depending on where the value ends up.
I would say be consistent. So one of the interesting, of course, parts of crypto is it's traded 24/7. So the value at 9 a.m. is different than the value at 5 p.m. and it's different at midnight. So the open question is, on that day, how should I value that? There might have been radical fluctuation in the value. And you shouldn't pick and choose the best answer for each situation. You should just be consistent. In tax, we call it a method of accounting. You should just not try to game the system or argue that you're trying to game the system. That goes back to the point about whether you have credibility in any enforcement so that you have an answer for that. So you should just try to be, so like proof of work token that you might have received, it changed in value on the first day pretty substantially. So like, how would you value that? And I think the answer is like, just choose a method that you feel comfortable with and stick with it overall. That's also true in terms of measuring gains or losses. So gains or you can calculate gains or losses in a variety of different methods. You can choose LIFO, you can choose FIFO, you can use specific identification. And the IRS basically has said what we call specific identification, which means you can pick the basis, the token you want to use and deem that to have been sold. Whatever method you have, you need to both track it, maintain it, and be consistent about it. You can't game the system.
And on the tracking side, as a part of our tech stack, we wouldn't be able to do our job if we didn't have a crypto subledger partner. And basically, they will, be consistent. They will price and give us the journal entries for the P&L. But really, relying on a solid crypto subledger we couldn't do our job without it.
And I'll give you one last horror story. Let's call it Project Wolverine, paying a bunch of their employees in tokens, and the token price, skyrocketed. So you'd think everyone would be happy, but people are getting tokens they can't really sell because they're employees, and they're supposed to be getting about $10,000 worth a month. All of a sudden, the project 100x's. Everyone should be happy, but no. Meanwhile, they're getting $1 million worth of tokens because the price went up so much, but they can't sell them. And then say the price goes back down. Now it's still doubled, but $20,000 a month. But they have a $500,000 tax liability, and even if they sell the tokens at a loss, it doesn't wipe out that ordinary income. And you can probably hire a lawyer to argue it wasn't worth whatever, or valuation haircut. But again, if they would have done an 83B at the beginning, you would have avoided all this. And so we're dealing with this in many situations. It's pretty tough.
You might want to explain 83B. Because
83B is like, I received these tokens. They're worth $5,000 today. I'm calling it income now, paying the $2,000 in taxes now, and it's not income as it vests in the 4 years, 12-month cliff, 136th after that. So you basically upfront pay your taxes, which can be a risk, but you avoid like massive exposure in the future if your project does well, which is what we all want, right?
Yeah. All right. I know you had a question, and then we're going to get to you back there, hopefully. I think we have time.
Hi, Crystal Kim, reporter from Axios here. I wanted to revisit your point about staking and whether it is a taxable event or not. What's the thinking around that? And could you also talk about liquid staking derivatives and whether those would present a taxable event?
So I think the IRS will very clearly tell you that it's taxable. So staking rewards are taxable upon receipt. So when you have control over those rewards and you can monetize that, I think that's the generally considered view. There is a case that you're probably referring to. There are people who have challenged that proposition, and they argue that it's more like you're baking a cake or you're a miner, and so therefore the rewards are only taxable when you do something with them. So you receive like ETH staking rewards or whichever rewards you have, and you should only be taxable upon them when you finally convert them into fiat or do something else with them. I don't think that's probably going to prevail. I don't think that's likely, but certainly people are entitled to their own view. That's been challenged in a case called Jarrett, which you may or may not know about. I think the better answer that most people think about is that it's taxable upon receipt.
Yeah, I think this is a perfect example. Like, it is a taxable event according to the IRS, but there are, groups in the industry, Proof of Stake Alliance, who are like, hey, this is, hurting decentralization of my project. So they file it as a taxable event, pay their taxes, then amend their return, get the refund as a way to challenge this. But it's not actually a gray area. And the problem is, I would say people are arguing it should be a gray area, but then there's hundreds of people saying, wait, I don't want to pay taxes on my staking rewards, and getting themselves in trouble because they actually do owe taxes unless they're planning to budget a lot of money to fight the IRS. So like, this is a perfect example of like, what you read is you got to be careful. What's the source, and what's the real facts underneath it all?
The IRS has actually said that mining reward in those FAQs that Zach referred to, mining rewards are tax. So you mine and you receive validation tokens as a result of that. The actual FAQs tell you that's taxable. Now, there's no FAQ on staking, but I think largely most people would think that the same result is that you are taxable on that.
Okay, we're getting the blinking red light, so we're going to go to this last question here real quick.
Test. Thank you for the information. I appreciate you guys being generous with your time. I want to talk for a minute about validator rewards. I run my validators through an LLC that's owned by my backdoor Roth. Any thoughts on validator tax minimization strategies?
Well, if you have a Roth, you're not paying any taxes anyway, so you've already, hit the holy grail of it. But if you did have taxes, yeah, having expenses that cancel out, it's really hard because you have to pay your expenses, but you don't want to sell and have a gain or loss. But yeah, own your validator through a backdoor Roth, and you don't have any tax consequences, I'd say. Okay. But just be careful.
I think that's a little more controversial. Yeah. So a Roth itself, or a non-taxable trust, an IRA, a 401k that you may use to own assets and to receive validation rewards. So passive income is generally non-taxable, financial income, dividends, interest, capital gains. Staking rewards don't necessarily constitute passive income that's non-taxable from an IRS from the standpoint of the tax code. So it's an open question, really, whether staking rewards are taxable or non-taxable, even if you own them in a non-taxable form. So I don't think that's without controversy. We all have probably a different perspective whether they should be. So, I don't know why that should be any different than the other forms of passive income that people may receive. But there's no clarity about that. And therefore, if you're forming an IRA and you have trust fiduciary obligations, because someone has to be a fiduciary for an IRA, the fiduciary may have a different perspective than you do about that. And the fiduciary has to report that income. It's what we call unrelated business taxable income, or UBTI, in tax land. So I just think be a little bit mindful that that's not without controversy.
All right. Thank you, time clock people, for the extra 3 minutes. Shehan or Sam, any last words? And then I think we gotta make sure we don't slow things down too much.
I think, best advice, have good systems and have good professionals advising you.
Thanks for attending. Be tax compliant.
Okay. Thank you so much, everybody. I appreciate that we got some good questions in. Enjoy the rest of Mainnet.